All right, I've got the fun part here talking about money. So as we look at this, let's just dig into it. When you look at this process for so many people, I know we talked about stress earlier. I think money puts a lot of stress on families regardless of if you can pay the full bill or, if you don't know. What I find the biggest mistake people make is really not knowing before you go. Most people don't understand how a school is going to view you financially. And I want to tell you this, schools operate like a business, all right? So if you understand that and understand their business practices, you can level the playing field. Everyone in this room, regardless of your income, should save on college. We don't want you to overpay. The 4 primary ways, the first one's going to be selection. We're going to talk about financial aid. But when I talk about financial aid, I want to change that definition for everybody in the room. Think of financial aid as money, okay? It's not just need-based aid, it's merit-based aid, and at a lot of schools there's a principle called discounting based on how you apply to other schools. So again, we're going to talk about scholarships. One of the best scholarships actually is a tax scholarship. I get a lot of feedback on that. You changed the mic? There we go, it's better. And then we're going to talk about college financial planning. Everybody in this room at a minimum should save $2,000 to $50,000. Small business owners, you have an incredible opportunity in what I'll call the tax scholarship area. You can easily save on average $20,000 to $40,000 regardless of the school that you're going to. Really our mission and the primary mission of today is I want to help you save on the cost of college. Most of our industry gets you to save for college and doesn't train you the tips and tricks to really save on the cost. Why are most of you still sitting here after being here for 4 hours? Probably because of the cost of college is ridiculous. If you look at in-state on average, it's $25,000. That is for 1 year. We're talking about elite schools. For many of you that are going to be full pay candidates, that's going to be $70,000 plus a year. So understanding, look, we want to end the student loan crisis. There's $1.4 billion worth of student loan debt. And I'll tell you why. Because most people go about this process backwards. All right, they pick schools, they pay the first year, and then they try to figure out how to pay the remaining 3 years. What I want to do tonight is I want to get you in the frame of mind to really start building that 4-year funding plan now. See which ways that you can save and understand the strategies. Because again, I don't want you to be another statistic. So let's talk about financial aid. One of the things that I hear, we always talk about fit. And the admissions industry does such a good job about training you guys on academic fit and social fit. I think what's really left out a lot of times is financial fit, helping you understand what is that financial fit. And for us, what I have seen over the last decade, people do not understand their financial fit first. They get themselves into a situation where they have the valedictorian, done tremendous things, extracurricular, and parents have promised their students since they were this high, you work hard, get into any school, and I'm going to pay for it. A lot of families don't realize there are 83 schools out there that don't give merit money. And many people are going to apply to those. So you have to understand those schools unless you want to be a full pay candidate. Unfortunately, those elite schools on average are $63,000 to $75,000. So please know your financial fit first. Really the 2 primary buckets are merit-based aid and need-based aid. Again, if you make $1 million, you can get merit-based aid. If you make, $100,000, you can get need-based. One of the biggest myths out there is, I make too much money to get financial aid. Now, a lot of times that is actually wrong. Many people don't realize, depending on their financial situation, the opportunity to modify their financial situation, or the profile of how many students they have in. A lot of people are going to be eligible for financial need that don't think they are. Really, if you look at this wheel, everyone in this room is going to fit into one of the 4 quadrants. One of the things I see out there is I see a lot of people presenting financial aid workshops, talking to you about, hey, we can lower your EFC. We'll get into EFC, but I want you really to be cautious of what you hear out in the marketplace, because, yeah, most people can lower somebody's EFC, but at a lot of schools it doesn't matter. So really understanding how you fit on this quadrant is really going to drive your strategies. As you look Category 1 families, they are high merit, low need. So understanding that, what are the strategies that you can use to save? A lot of times, tax aid and test prep are your biggest strategies to save money, and focusing on merit-based schools. So I definitely would recommend everybody understand where you fit there, because these strategies are going to help you save on the cost of college. So let's take a look at this. I don't want anybody in the room to rule out a college based on sticker price. So right up here we've got cost of attendance. That's going to be tuition, room and board, books. That is for 1 year. So if you want to see if you're eligible for financial aid, you're going to take the cost of attendance. You're going to subtract something called your expected family contribution. Your expected family contribution is the guidepost that schools use to figure out how much you could potentially pay at their school. Most people are going to pay more than their EFC. A lot of people will pay their EFC, and if you do this right, at some schools you might pay less than your EFC. EFC's 4 primary drivers are parent income, student income, parent assets, student assets. There are about 6 other variables that go into the equation. Simple math, sticker price at the school minus an expected family contribution equals need. Example, $60,000 school, family's EFC is $20,000, $40,000. So this family needs $40,000. Most important question, and a lot of people stop here assuming all schools meet 100% of their need. No, you have to understand how a school meets need, because many of them will do it 100%. And those, if you all have an elite student and a financial situation meaning a low EFC, you want to apply to the schools that meet 100% of your need with free money, grants and scholarships. All right, so that is such an opportunity that's missed every year because people don't understand how this process works. Here's another thing. You have to understand, especially your big public out-of-state schools, they don't have the finances to meet need, and they might only meet 30 to 50%. So again, that know before you go concept, before you really start applying to schools, is a great strategy we see people save on money. So how do you get it? So many of you have probably heard of the FAFSA. So in order to figure out your EFC, you're going to fill out one of many forms, but it's primarily driven by the FAFSA. Now there are 3 methodologies for figuring out your EFC. If you're going to work with anybody in my space, here's the trick question. Ask them, how many methodologies are there for figuring out my EFC? If they tell you 2, then you need to run for the door. There are actually 3. There's a federal methodology, there's an institutional methodology, and there's a consensus methodology. I'll get into why each one of these is important. But understanding your EFC is critical. Here's the thing. If you apply for financial aid and fill out the forms, you have to do it every year. So if you have a material change, good or bad, in your financial situation, you have to know that before you start building your 2nd, 3rd, and 4th year of college costs. So let's talk about, everybody in here should fill out the FAFSA. I don't care if you're Bill Gates. This is the only way that you can get federal loans. And I'll tell you, the best federal loan out there is the direct federal loan. And the reason I think it's the best loan, it's the only loan that's going to be in the student's name. It's the only way for you as a parent to create accountability. Those of you who've sent children to college, think about it. You're sending them to college with a check. There's no accountability there. So again, this can be a great tool to create some accountability. But this methodology is going to be used by every college out there. So understanding when they look at your income is important, because most people don't realize that they go off something called a prior year. So a lot of times what they'll do when you fill out the financial aid form, the number that they're going to use to calculate the parent's income is going to be the sophomore spring, the junior fall. Most people think it's last year, and that's actually not the case. So if you have the opportunity as a small business owner to change your financial position, maybe lower your income legally and ethically, you really need to get ahead of the curve. Many people don't understand when they look at the income. So again, these are the primary drivers: parent income, parent assets; student income, student assets. So let's look at the formula. So this is just for the FAFSA. As you look up there, parent assets, but they do give you what they call an asset allowance. I had a family come to me the other day and said, "Stuart, this guy told me to move all my money into some financial product." And I said, "Well, did they talk to you about the asset protection allowance?" "No." Well, that was about $37,000 for that family that they did not need to actually move into that guy's financial product. So understanding this is important. And again, student assets. This is a big one. I see a lot of people have UGMAs, UTMAs, or Coverdales. The colleges weigh these assets on some of the formulas a lot heavier than a 529 asset. Again, you might hear and seen some articles out there, are 529 assets, do they hurt financial aid? They increase your EFC, but again, depending on selection, it might not make a difference. But understanding this formula is important. So what assets actually increase your EFC? Anything in what we call an after-tax account. So brokerage accounts, checking, savings, 529 accounts, custodian accounts, stock options, second homes, rental properties, some good things that don't. Small business. If you are a small business owner and you have less than 100 employees, you do not have to report the value of your business on the FAFSA. Now, when we get into the CSS profile, we'll talk that's a little different. But again, those things increase your EFC. What accounts don't? At most schools, your equity in your primary home does not. About 186 schools in the country will actually assess the home equity you have as an asset you can use to pay for college. And that's going to be on the CSS Profile schools. But retirement accounts, one of the biggest things I see when people come in showing me what hey, my EFC's, 6 figures. Well, a lot of times they're putting in their retirement assets. So that is one huge mistake people make every year. So don't put in your retirement assets. Again, looking at those are not countable. So this is a great example. Somebody with an AGI that are married, $31,000. So a lot of people think at $150,000, I'm not need eligible. But if you remember the formula, cost of attendance, that's sticker price of school. So if you're looking at a $70,000 school, and your EFC is $32,000, you're going to be need eligible. And if you pick the right schools, the ones that meet most of that with free money, then that could be an incredible educational opportunity for your family. So again, don't think you're not eligible for financial aid. So is the FAFSA the only form? No, there's an additional form at about 387 colleges. It's called the CSS Profile form. This form has about 100 additional questions than the FAFSA. And really all the questions are driven by your financial position. They'll ask about small business, they'll ask about home equity, they'll ask about debt, they'll ask about if you're paying private school tuition. And really what the schools are trying to do is, these schools want to give you money, but they're giving it to you out of their pockets, so they want to make sure they don't give you too much. So it's important to know, as you're selecting schools, understanding what form they're going to use and what methodology, because it can have a significant difference. So again, the 2 forms that you're going to fill out, for most of you, I'm assuming most in the room are going to elite schools, the FAFSA or the CSS Profile. One factor that most people don't know is this: the schools can go off either formula. A lot of times they'll go off the higher, just because they don't want to give you more of their money. Now, there is another group and another methodology called the consensus methodology. And this is called the 568 President's Club. It's just 23 universities in the country. So if you guys want to take a picture of those are the schools that use this. The good thing about these schools is they do not penalize a family student who've saved. So for instance, as you look at the key differences between each formula, you'll see over here, under the consensus methodology, they only weigh assets in the student's name 5%, where the CSS Profile is 25, and then the FAFSA is 20. What does that mean in real dollars? If you have saved $100,000 in an UTMA, UGMA, or Coverdale, if you follow the FAFSA, that's going to increase your EFC $20,000. If you file the CSS Profile, it's going to be $25,000. If you're applying to one of the consensus methodology schools, it's only going to be $5,000. So understanding how these schools are going to view your financial position can really help you with strategies to save on the cost of college. See this all the time. Again, people don't understand how the form works, particularly as it relates to two students in. A lot of times you'll fill out the form yourself, or maybe use a net tuition calculator at a school, and your EFC will be $60,000, $70,000. Then you just, again, say that's my EFC, it is what it is, and move on. When you have additional students in school, it is going to lower your EFC. And really the formula, it's going to divide it in half and then multiply it by 110. So it's about a 60% reduction. So in this case, I see this every year. Family makes $150,000, they've got assets, EFC is $36,000. They're happy with a financial aid award. However, they didn't realize, well, we've got two in school, and we can actually do some things to modify our EFC. And really, at the end of the day, it was about a $100,000 decision. So let's talk about scholarships. One of the things you see out there is a lot of colleges, and your more elite colleges, are going to view your outside scholarships as a resource of the parent. So when you're talking to these schools, before you have your students spending a lot of time getting these outside scholarships, you want to ask the school, if my son or daughter comes to you with a $5,000 Chick-fil-A scholarship, how do you view it? Okay, and really they're going to say, well, we're going to view it as a family resource, meaning it's going to take away your aid. So at a lot of schools, especially elite schools, studying for those and writing those extra essays and going through those extra steps based on your situation might not be ideal. As you can see, 86% of all scholarship dollars actually come from the universities themselves. One thing that's missed significantly is you just look on the website, you see the 4 or 5 basic scholarships. You really want to call the financial aid office and ask them, are there any additional alumni scholarships? And especially when you have students in their second year, they estimate that over $1 billion of scholarship money goes unused because upperclassmen do not think that they're eligible for any outside scholarships or there are any available. There's tons of money available, especially if you didn't get it that first year. The one thing I do like to warn people about athletic scholarships, you might have a very gifted athlete, but that is really only 1% of the money. So for most of you, you probably make over about $220,000 a year. You're not going to be NEED eligible, and maybe you know that. So how do you save on money? You really want to apply to the schools that award merit scholarships, obviously. But you want to understand the category of merit scholarship based on the school. First, there are a lot of schools that offer competitive scholarships. Now, the thing with a competitive scholarship, you have to apply outside of the application. So a lot of families don't look at, are there other additional scholarships, and they assume when they see it that, hey, my student applies, they're automatically going to be eligible. No, a lot of schools have what they call competitive scholarships, primarily driven by essay and test score. Many schools use what we call a grid scholarship. And as you look at big out-of-state public schools, the majority of them go off a grid scholarship. Your financial position, if you're NEED eligible or not, doesn't have a significant impact on you saving money. If they follow a grid scholarship, the most important components are going to be your GPA and your test score. So if you're ever looking at making an investment, a lot of times test prep can be your best return on that investment. And there are a lot of schools like Tulane that offer package scholarships. And what is a package scholarship? Package scholarship is the school actually put together something unique and specific for the individual. And why do they do that? They do that when they have an applicant that's in the top 25% of an incoming class. So if your student is in the top 25 of an incoming class based on GPA and test score, and you're applying to specific schools, they might award you a package scholarship. Why are package scholarships so important? Because a lot of times if you apply to other schools that award package scholarships, you can appeal and negotiate and potentially get those schools to compete for your student. And how a college competes for your student is through their pocketbook. 66% of all colleges in this country have a hard time filling seats. They want to compete for students. Now, most of you in this room, you know, the top 83 schools, they're not going to compete for students. They don't need to. But again, as you look at your list, you know, if you're looking at safety and target schools, maybe looking at ones that do package scholarships can be a great opportunity to save. This is an example. Alabama does a great job, all right? 27, ACT with a 3.5, you're going to get a 4-year award of $14,000. 32, you're going to get $107,000. So again, as you look at these big out-of-state public schools, you have to understand most of them go off a grid scholarship. And if your student doesn't hit the grid, with exception to maybe using the academic common marketplace, you're not going to get awarded money, even if you're NEED eligible. I see it happen so frequently, especially since 70% of all HOPE recipients apply to Georgia and Georgia Tech, making those schools very hard to get into. Students that those schools appeal to are going to look at the Alabamas, the Clemsons, the Auburns. So understanding this is important. So school selection drives all of the strategy. If you are a need-based family, you want to apply to schools that meet 100% need. Where do you find this information? CollegeData.com is one of the best sites out there for information. It also is going to tell you important things like early action and early decision. Derek had talked about enrollment yield, so it's going to give you all the data that you need to make an informed decision if you want to do this yourself. Now, if you're a family that makes a lot of money and you want to save and you don't want to pay full pay, or maybe you can't afford to pay $75,000 a year, you want to focus on the schools that award merit-based money. Now, one thing I see a lot of people make a mistake with, if you have a situation where divorced parents, a lot of times they'll try to use the financial aid system to their advantage, and they should, but you have to understand the schools you're applying to. A lot of schools will only ask for the financial information for where the parent and where the student lives. That's it. However, there are quite a few schools, especially CSS Profile schools, that are going to ask for a form called the non-custodial parent form. They want to know the financial information, regardless of your situation, regardless of what your tax return divorce decree says. So if that's your situation and you're trying to use that to your advantage, make sure you don't apply to a school that requests the non-custodial parent form. That could really hurt your financial aid. Again, understand this is net cost. It's not sticker price. You shouldn't rule out a school just because it says $70,000. You want to understand your financial fit. You probably can't see that because of the color, but this is a $50,000 school. Family's EFC is $15,000. First question, how do you meet need? In this case, this school meets 90% or 80% of it with free money, $28,000. So you want to look at the net cost. So as you go through this, my EFC is 15. Well, they only met 80%. They gave me loans and work study for the other 20. What is my net cost to attend that school? In this case, it's $20,000. Now, this is what we see at a lot of public universities. Low cost of attendance, but also they can't even meet 50% of the need. So when you add up your EFC, an unmet need, and how they structure the rest of it, this is a potential $20,000 decision. Now you get a school that meets 100% of the need at $60,000, that's a 15. Now I'm not saying make the final decision based on price, because this could be the best school for your student, socially and academically, but understand financially. A lot of times what we see is these big public schools, their four-year graduation rates are significantly lower. So if you're a need-eligible family, you need to work the system. How do you do it? Use College Board as a great example. So if you're a family who you figured out your EFC, you figured out that it's over $75,000 and you want to save, what number do you need to look at? Well, on the site's college data and College Board, you'd need to look at the average non-need-based aid. That's really the merit money that they're going to give families that aren't need eligible. But as you can see, the average first year award is $41,000. So families that are need eligible. Now, I see this every year and it really kills me because these students have worked so hard and the parents didn't know before they went. And this is the situation. They make just enough money not to be need eligible. Got into Yale, cost of attendance, $60,000, $70,000, and a lot of families can't afford to write that check. So if this is your situation, you want to make sure, and I always say, look, even if it is your situation, I think it's great to apply to an Ivy League if you can't afford it, just so if your student gets in, they always know. They're at that cocktail party, people say, oh, I went to Yale, Harvard. Your student in the back of their mind is, yeah, I got in, but I didn't want to pay that. I went to another school that was a better fit for me socially, academically, and financially. Again, net cost is all that matters. So if you're need eligible, I can't stress this enough. $25,000 school, if your EFC is 10, you need $15,000. How does a school meet need? What is my net cost? Okay, because I could be looking at a $25,000 school, I could be looking at a $52,000 school. Depending on my EFC and how a school meets need, I could be missing some significant opportunities for my families and my students. Now, for those of you that aren't need eligible, again, net cost, understanding that we had a lot of conversations about MIT. Well, for a lot of people, MIT is going to cost you $253,000. Look at a school like Case Western. Again, family's EFC $75,000. The school doesn't cost $75,000. There's no need. However, it offers a merit scholarship. And again, if you do this right, you could potentially appeal that and get some additional money. So those are the primary two ways to say it. And I will tell you this, and I know a lot of you in this audience particularly, because I work with a lot of families like yourselves, a lot of time, I think higher education has sold us on the name on the diploma. For a lot of your students, depending on what they want to study, I'll tell you, the department level is a great way to save tons of money. So again, understanding what the pathway is for your student, what that potential return on investment should be part of the equation. I understand the value of a Harvard or Yale pedigree, but a lot of times it also depends on your track of education. Are you going on to graduate school? Well, if you're going on to graduate school and you're going to pay the full price, think of it this way. When you've gone into your doctor's office, do you ask them where they went to undergrad? No. You ask them where they went to graduate school. So sometimes if your student is on that graduate school path, picking a school that's going to be a great academic and social fit, where they're going to be elevated when they graduate, can really save you money on that overall education. Oh, you want me to do questions and answer? Okay, great. All right. Well, perfect. So again, I always recommend to people, you really want to map out your costs before you start applying to schools. Have a 4-year funding plan. If you're going to use loans, have a smart lending strategy. One of the loans out there that we see is the Parent Plus loan. It's one of the worst loans out there for education. There's so many better alternatives, so be careful. And also when they're awarding your student money, you're going to see, hey, we got a $42,000 award, but you're going to see on there a lot of times, Parent Plus loan $25,000. That is something that needs to be paid back. So with that, please, I'll take a few questions. Yeah, go ahead. Yeah, why don't we let everybody go who would like to go, and if we have questions, I'll take some out in the hall. How's that sound? Perfect. All right, no problem.